So Grant Cardone has a very famous way of looking at real estate. He says it's all about the deal. In your perspective, is that true?
Yeah, 100%. Because real estate is worth different amounts in different locations. And, different property types can be incredibly valuable, even if they're not like the coolest or sexiest building, even if they're not in the best market. So it really is all about the deal. There's a concept in commercial real estate called the cap rate. And a cap rate is the net operating income of a building divided by its value. And so, the higher a cap rate is, the more income a building will kick out relative to what you pay for it. So, if you can get a building at a really high cap rate, it will generally perform better than a building at a really low cap rate, even though, the buildings at a really low cap rate, they're a lot more stable. You have a lot more confidence that the tenant that's in those buildings, or the tenants that are in those buildings, will be there for a long time, and that's why they're sold for relatively, they're generating relatively low income relative to their value. Whereas riskier properties, you can generally get them at a higher cap rate because there's a higher probability that a tenant leaves or defaults, and that revenue isn't sustainable, or it's not in as attractive of a market, and the risk is that the properties won't go up in value in that part of town as much as somewhere else. So it is really all about the deal. And not necessarily from a pure real estate play, but the Holmes Hardware building in downtown Pueblo, being a really prominent retail building on the main street, is a lot sexier than Fuel Kitchens, which is an industrial building on the east side of Pueblo, kind of tucked away on the end of an industrial street that, because it literally dead ends at the building, you would never go past unless you're going to the building. But it may be that Fuel Kitchens ends up being a much better investment because, the revenue generated is high, could be higher, and the cost of the building could be a lot lower. So it really just depends on the situation, and a cap rate, or another way to look at it is called the cash on cash return. Just simply, how much money do you get at the end of the day after paying your debt service and all of your expenses relative to what you pay for a building. Those are good ways to evaluate the potential of a project. And even if it's a totally unsexy building, if it's something that allows you to generate a good bit of revenue, you can then sell the building generally because of cap rates. You might be able to sell the building for a lot more than you paid for it, even if it, is not the most prominent or sexiest building on paper.